Before we get started with the episode today, we have a very exciting announcement. The Stablecoin podcast now has a sponsor, and it's one we're genuinely delighted to welcome. Nephos Group are specialists in proof of reserves and accounting for stablecoin issuers. They help stablecoin issuers with the financial infrastructure, reporting, and compliance that underpins trust in their tokens. We're thrilled to have them on board. You can find more at nephosgroup.com. Welcome back to the Stablecoin podcast. I'm Luther Madej with my co-founder and co-host Rami Soleiman. Today's guest is Pritpal Shokar, head of product for digital assets at Thunes. If you've ever sent money internationally through a remittance app, a B2B payments platform, or a corporate treasury system, there's a good chance that Thunes was the infrastructure underneath it. They're one of the world's largest cross-border payment networks. In 140 plus countries, 90 plus currencies, connected to over 12 billion wallets and bank accounts globally, all accessible through a single API. Today, we're getting into what it really takes to ship stablecoin infrastructure at a global scale and where agentic payments fit into all of it. Pritpal, welcome to the show.
Thanks, Ethan. Yeah, great to be on. Thank you for your time.
Absolutely. How did you get started in this? I've been reading some of the works that you put on, especially you've been very vocal around agentic payments, but your transition into the space is very fascinating. Can you kind of walk us through that?
Yeah, sure. Actually, I've been fascinated with money as a topic all my life. So I can recall when I was, very young, I think my first job my father had was going door to door, collecting, cash and coins, collecting insurance premiums door to door, bringing it home, counting it in piles, taking it to the post office. And ever since then, I've been fascinated with what is money. And I still think that's an open question to a certain extent. What is money? And then from there, my actual first job landed me in retail banking, so as a cashier. And that's when actually it came a little bit full circle now. It was me counting the coins. So you had, individuals, businesses coming, dropping off large parts of money, counting it. And then I kind of moved more into the actual fintech space. Started off with actual credit risk, looking at actually the fundamental pipelines behind how is risk managed, what does it actually mean? Kind of, and that kind of overlaps with reserve management that we're seeing today in the stablecoin space. And ever since then, I've been really looking at, well, how does money move digitally now? So looking at, technology, thinking about not just moving money internally, but also, cross-border on a true global scale. And that's what's brought me into the FX world, where my, previous roles have been looking at cross-border payments, FX, liquidity management, and now joining Thunes quite recently. It's actually on a true global scale. And you mentioned some of the stats there, the true global coverage we have here, which really enables businesses to operate on a global scale.
Yeah. With the transition of money from what we know, right? Like you said, coins and, notes to what became digital money, right? Like we've been through this, like Rami and I, have been through this definitely from that perspective, where we said we're going from something physical to something that lives somewhere on the internet, right? Like you just open your bank account and there's a balance there. And then now we're looking at another transition from that perspective, which is money, digital money that moves at the speed of the internet. What are some of the challenges that you're starting to notice where this concept is starting to run into a few, I would say, not challenges, but, hurdles when it comes to global capacity when you're operating something at the size of Thunes?
Yeah, sure. I think the first thing is thinking about how we actually frame stable coins. And it's a little bit of an open debate at the moment. Is it actually another type of currency? Or actually, which is kind of our approach, which is that it's more of a kind of funding rail and not a product in itself. So what we've seen actually is that although stablecoins have product market fit, as we've seen for cross-border payments, it is still trapped in that chain and that ecosystem. And whilst to a certain extent we're seeing, evolution of, products where stablecoin usage is taking off, we've seen some, card players in the market. When it actually comes to real world use cases and needs, locally, businesses still need to pay, local suppliers and need to pay their taxes, invoices in local fiat. And the challenge that we've seen is that if you try to build solutions purely just on chain and using stable coins, you're missing the real problem you're trying to solve, which is truly moving money in a digital form from point A to B globally. And that's the challenges we've seen. And You mentioned that coverage we have at the moment over 90 currencies. In each of those currencies, there are different regulatory, requirements, different controls in place, and that's where it takes time to understand the true local nuances, and that's where I think we've been becoming more and more acquainted with, over the last 10 years, the network we've built. It takes time and energy to build that.
I think that you make a really good point in that Thunes and similar companies have spent many years going through the regulatory hoops to abstract away the difficulty of moving money around. People don't realize that it's actually value is moving in complex patterns across countries, particularly different regions, different currencies. You abstract all that away to make it almost P2P easy for people to do. And I think that, well, almost you've done too good a job, because people don't now realize that with stablecoins and other digital money, that actually this is fundamentally good for the back end, but maybe in the front side of the equation, people won't notice that much difference in certain use cases. So it's interesting from that. And I think you're right in terms of what is money. It's a more conceptual conversation as to what is money, where does stablecoins fit on that. I think the Bank of England and Treasury and the FCA back a few years ago, when we sort of started in stablecoins, the argument was around the failure of the singleness of money. The stablecoin didn't meet the 3 criteria that defined what money was. So I don't think we're any closer to solving that. I think people have taken their positions, and there's been an evolution of digital money, CBDCs, tokenized deposit, bank tokens, and stablecoins are all on that fluid side. But I guess the question I wanted to ask you, Pritpal, which was, how do you see at Thunes stablecoins and digital rails improving your efficiencies compared to traditional e-money channels? So at the moment, like, we had e-money before stablecoins, before blockchain, there's e-money, and it was happening for ages, and e-money providers are around for a long time. How do you differentiate the two? How do you explain the two to customer, and how do you use them internally?
Yeah, great question. So I think for a lot of people, I think they're still seeing stablecoins as something you hold. And I think that might be a misunderstanding. So we kind of think of more about something you move through, and that's kind of the way I like to think about it. And just before I answer this question, you made a good point around me before around the kind of back office and front office. I think what we've been focused on here is actually building back to front rather than front to back. So as you mentioned, a lot of people see the send side, and I think stablecoins is a great entry into that. To get stablecoins and to use it as a kind of funding mechanism is relatively easy now. It's getting easier, less friction. But then actually using that to reach your terminal endpoint, that is still where the friction is. And so you mentioned around, where we specializing in the last mile payouts, that's where, more of our kind of innovative approaches now is we're looking at how do we use stablecoins and the rails behind it to optimize more so for intra-money movement. So you mentioned about liquidity optimization, for example. That's kind of where Tunes really first started, which was we internally thought about how do we leverage this new technology to optimize internally. Let's do a little bit of a proof of concept of how we think actually it brings benefits to us, and we solved internal problems. From there, that really enables us to think, well, now that we've started solving internal problems, how do we think about it from our customers' perspective? So we've thought about it from a pre-funding mechanism to start with. So our customers now, they can pre-fund in stablecoins. So USDC, for example, that allows them to reel up the benefits of cost-efficient, fast global funding. But more importantly, in this pre-funding model that we all live in the remittance world, it's all around trapped capital. And this is what we're trying to get away from, because any capital, our customers aren't holding at any point in time. They're potentially losing out on interest in yield. So we're seeing that. Coming back to what you mentioned about difference between kind of e-money and kind of like these tokenized money. I mentioned my credit risk background. A lot of it is around, fundamentally from a regulatory compliance perspective, what is the underlying mechanisms behind that? And what surety do you have? So whilst we know there's regulation in place to ensure, one-for-one backing in reserves and so forth, ultimately, I think as we're seeing in the market, tokenized deposits, as an evolving theme and adoption now, I think that is more the regulated space. And I think that is more similar to actually e-money, because it's issued directly by the banks, and that's where we're seeing a lot more appetite from some of our larger, business and B2B flows, focusing more on that side.
That's very
Yeah.
interesting, Pritpal, because I have a slightly different take. If we go back to this concept of what is money, and maybe Rami, that's our next podcast, is the What is Money podcast. But it's like if we look at what is money, at the end of the day, it is it's some mechanism to transfer value at a very high level, right? And but tokenized deposits, they don't have that cross-border nature. Like it's as they kind of exist today, they still have a little bit of friction when it comes to sending from one country to the next, which stablecoins do solve. And not to bolster the use case for stablecoins from that perspective, just because this is the stablecoin podcast, but there's something about tokenized deposits that they have the blockchain aspect to it, but they come with a certain amount of baggage that traditional fiat currencies have, or fiat funds have, when handled by a bank. Like, how are you guys looking at that from that perspective? This baggage, baggage packed tokenized deposits versus stable coins that some may argue that maybe they're too free to kind of roam around.
I think Tune. So, our general thesis, even before we saw stable coins and tokenized money, was around being really agnostic of currency, and rail, and that's what we've really been building at, because we want to unlock global access. So we don't really bet on which money is going to win. Again, that's an open debate. We think about the use cases specifically for different types. So I totally agree with you, Luther. I think with tokenized deposits, in its at least initial formats we're seeing, it is more of a permissioned kind of networks that we're seeing it, where it's seeing market fit. And it is more so around kind of institutional flows moving between participants. I know we've heard recent announcements about consortiums trying to get together and create their own, clearing networks, for example. I think that will help to a certain extent, because then it's not just on a bank level. In terms of tokenized deposits versus stablecoins, tokenized deposits, I think we're seeing more of a market fit for liquidity purposes. We're seeing that as a separate use case for actual stablecoins. So for us, we see the different layers, and we are truly around, and this word gets thrown around a lot, interoperability. But that is, and I would say, in your last Luther, right, it is a common thread as well.
Yeah.
But I think unless we have the interoperability, there's no point in having a single type of currency. They have to all interconnect. And that is the whole objective, I think, of global access. And unless we have that, it's not all going to work.
It's so true. You're so right. I mean, it's so funny because we laugh about that word interoperability and everyone's talking about it. In crypto land at the beginning, last year, interoperability meant between blockchains themselves. That was if you issued your stablecoin on a different blockchain, how do you get interoperability between it? But now it's interoperability and fungibility between forms of money. I think that's the point. And it's weird because, not weird, it's amusing that tokenized deposits are getting form factor fit amongst the larger corporates, even though, ironically, they're fractional banking products at the end of the day, but they would prefer those to a fully funded stablecoin. So if you ask your corporate treasurer, would I rather have a JP Morgan coin or a Citi Token Services token as opposed to a Circle, a USDC, they would probably go with the bank product, I think. So that's interesting. But you're right; it's that interoperability is going to be key in terms of the scaling of these products. And of course, Luther has been talking the last few weeks around Genius in the US and Clarity, and that sort of back and forth between the stablecoin native companies and the banks around yield and so on. So that's sort of an area for debate, but fungibility between the products actually solves that, because you can be in a stable coin for payment or for final transfer, and you can be yielding in the other product. So I can see that's definitely the setup that I can see probably corporate treasury companies adopting in the future.
In a sense, if you think about it, on and off ramping is interoperability with fiat currency, right? I mean, like, essentially we're creating that bridge between the two worlds from that side. But when it comes to interoperability, one of the biggest challenges is the liquidity. It is the fragmented liquidity, right, Pritpal? And In order to operate at the scale at which Thunes operates, how much of that liquidity, if you can talk about, like, is um, network driven, as in you have partners that provide it versus you're kind of having to kind of provide it yourself?
Given the depth and coverage of currencies we have, we know outside of the major currencies, some of the exotic currencies we've got,
Mm-hmm.
a lot of it is driven by our kind of internal, we call it the Smart X Treasury platform, which is all around forecasting, but very smart forecasting. So given the type number, the volume of flows we're looking at in one currency, another currency, a lot of it is, and this is why, again, coming back to the use case of stablecoins, when we're operating using fiat currencies at the moment, so we're funding, our network partners who are handling some of the FX for us, so we can secure the local liquidity ready for our customers, like when they submit their payout, instant payout for us. A lot of that is pre-funding us, doing a lot of planning around, holiday periods, bank holidays. We always think about the Chinese New Year when it's shut down for 2 weeks and, there's trapped liquidity there. That's why I think, again, coming to that use case around treasury optimization, that's where we are seeing market fit with stablecoins. So it's really helping us to resolve some of those funding challenges, especially over the weekend where we know sometimes it doesn't work. But the real challenge there, though, is that with some of the network partners that we have on board, some of the banks, for example, highly regulated, they're not yet open to receiving funding in stablecoins.
Yeah.
Because the clarity, again, isn't there for this. So that's number one. Number two is the infrastructure that they're lacking. So while wallets have been quite easy for, individual consumers to, spin up now, relatively easy, it's still on a, regulated bank grade scale, a challenge for them. But I think that is an evolving space. So I think the key challenge at the moment we've got, at least, is making sure that we correctly forecast to make sure that funds are always there. And also, whilst we, sometimes we ask our customers to forecast some of their volumes, they can have a surge in activity. One customer can spike all of a sudden, and that drives up our liquidity. So we always have to be mindful of trying to plan that. So a lot of it is a lot of modeling that we're doing in-house, and we're using, efficiencies to do that. And this is really helping us to get more efficient in that space as well.
You sit in UK, and there's quite a bit of movement right now in UK around digital assets in general, and especially around stablecoins. Can you talk a little bit about, or can you kind of walk us through some of the changes that you're seeing, especially on the UK side? Because I mean, UK has always been a center of excellence when it comes to movement of money in general and handling of funds, and so I think it's going to play a very vital role as we kind of look at how stablecoins and digital assets in general see proliferation through the globe.
You're right. So we do see the UK, it's, one of the global FX hubs and corridors, traditionally speaking. And I think we are seeing UK, whilst they're taking a measured approach to regulation, I do think by taking their time and waiting to see how some of the other regulatory authorities are moved, I think it helps them shape and define what they would like to do to make it work for them. And I actually attended a couple of months ago an FCA event where they invited industry participants to get involved as a first sprint event, and it's refreshing to see that actually they wanted a direct input from the participants to help shape that. And I think they're also decoupling the stablecoin issuance piece, which is around, issuing stablecoins versus actually how are stablecoins treated when it comes to a payment vehicle. And that's also good to see that granularity because, for EMIs and PIs operating in the UK, I think they're still waiting for that clear guidance of what they can and can't do. And until they get that, I think that's not going to be a catalyst. So they're waiting for that. It is also refreshing to see that sometimes, I think at one point in the UK we're mandating, potentially a hard cap on stablecoin, balances. And again, it's refreshing to see that, they are open to feedback and they've heard the industry be quite vocal in that space. And I think they're, reconsidering their approach. That's also good to see as well. So I think UK, whilst they're taking their time, it's a very measured approach. And I do think when it does come to market, I think, just as we saw Genius Act, it was an enabler. I think it also will be for the UK as well.
I have a question on that side, and I agree with you. I think that from a position of extreme conservatism, they've actually started moving relatively quickly to try and catch up, which is great. I wonder whether it's a little bit too late to see whether it's going to be dominant. But I guess the question for you that I had is, how useful is a sterling stablecoin in your workflows at the moment? That'd be because that's the key, I think, in terms of, if the FCA is going to champion something, it'll be a local stablecoin. And, sterling is not an irrelevant currency on the world stage. There's a lot of business that still happens in sterling. And as you said, London's the flow home of a lot of money movement. It's the home of FX and so on. So, yeah, I guess the question is, if there was a sterling stablecoin out there, would Thunes use it? What would be the conditions for that to happen, and how would it grow that ecosystem?
So I think we always looking at it, first of all, first we need a regulatory clarity. That's always kind of our foundational pillar. Then we look at the market demand and then our customer demand. So we look at some of the typical flows that we see from our customers from corridor A to corridor B. And if we think about the utility of a GBP-backed stablecoin coming out of the UK and it landing somewhere, it's thinking about what would be the use case there. Would it be a hold type of stablecoin?
Mm-hmm.
And if it is, what would that look like? Would they be able to generate a yield on it in some sort of way? And maybe that might entice big corporates to do that. Maybe they get access to UK yields, for example, UK treasuries. That might be offset because 90% of them currently are backed by US treasuries. So maybe that's the way that UK want to offset US treasuries, and maybe that's the way to entice users. I think that's quite interesting. But in that kind of, if you think about, B2C, whether it's a payroll use case or C2C remittance, I think we'll have to wait and see where that lands, because at the moment, I don't think it's particularly clear on where that utility will be.
Yeah, that's a good answer. And I think you're right. I mean, because I'm just thinking about when we're speaking to people like yourself, and we're not talking about the crypto ecosystem anymore. So it almost doesn't matter that the crypto ecosystem is 99% dollars. That's fine. We get it. But it's about sort of when it jumps out of that petri dish into real finance and international trade and international finance. And Lucy, you'll know when you were at MoneyGram, the amount of Vostro cash that's trapped in all of these different places to give the illusion of real-time money movement. These are the things that we're trying to solve. So just trying to work out, how do the different currency stablecoins fit in there, and certainly how does a sterling one fit in terms of doing it? Or will it be a sterling tokenized deposits? Could we see Lloyd's, which has been pretty active on the digital side recently, would they issue a tokenized deposit, a sterling one, for example? I'm just wondering where it goes over the next 18 months in terms of the UK being crystallizing this now momentum and energy in the right way. How does it manifest itself?
Yeah, it's a great question. And coming back to what I said earlier, I think at the moment, as the UK, because there's no concept of a tokenized GBP or stablecoin, and the large concentration in US dollars, again, most of the world is already in dollars. And I think, the Genie Sat, it was called Genie Sat for a reason. I think it's moving more flows onto the US dollar economy. And that's been a little bit worrying. And we've seen the central banks, right, consortium, they're now raising their concerns around this. So I think it'll be refreshing to see other central banks also come into space, just to even out the playing field and mitigate that risk and concentration of it, because I think that it could become a material risk, and it'd be a shame because we finally got technology there and we want to best use that technology to solve these real problems.
Yes. And I'm sure we'll get more clarity around that shortly. You like that, Rami?
I do. I can't take myself off mute quick enough to laugh. So, I'm just gonna...
Anyway, so, Pritpal, one thing that I know that you're passionate about, and so are we on the show, is not just the transition to using stablecoins, but this kind of intersection point between AI and digital assets, and with the formation of agentic payments, etc. A very recent headline from Visa, where they're all in on agentic payments and introducing tools for agentic payments. How do you see that changing cross-border money movement?
We're seeing this rise of the agentic economy, and I think we're starting to see the foundations there, just like we did see with the stablecoin space. So these agentic networks now come into place. So, we saw Coinbase start with the X4 team. We've seen, Visa come with their approach and Google as well. And again, when I think about Tunes and the types of customers we serve, so whether it's an MTO, a bank, a marketplace, whilst those businesses may come to a point where they delegate responsibility to an agent to transact on chain, ultimately the agents can't transact, in my view, without wallets and without crypto technology, without the credentials, and we're seeing that. Now, that though to me is more so of a kind of consumer layer, if you like to think about it. So, whilst you might ask an agent to go and book my flight for a, airline, for example, and it has a designated wallet it can draw through, that's great, fantastic, it might work. But that is, to me, again, being trapped on chain. If you then want to try to interact an agent with a human, again, it's a similar thesis around while you're off-ramping then from an agent to an individual. So we're actually going to come around full circle, I think, which is, whilst I think it's fantastic for an agentic economy being in place in terms of maybe driving more demand, the actual utility will be is that how do we draw it back out the agentic economy into real world economy? And we laughed about that term. And you know what I'm going to say? Interoperability once again.
That's right.
Yeah. So I think we're already thinking about tunes around how can we be prepared for that. So if that is a real use case and our customers, are interested in exploring that, how can we connect into that? And I think the ground foundation we're doing already, if it runs on the same underlying blockchain networks we're already using, I think it's a natural use case for us.
I would have thought that this initial implication from an agentic payments perspective would be more on the back end and less on the customer facing side, because when I think about the treasury operations in general, there's a lot of this, like you actually pointed out to this earlier. You said, hey, we're constantly looking at projections of what the flows were, based on historical flows, and then trying to project like what is our demand for the next few days, next few weeks, etc., and trying to manage pre-fund, whether that's stablecoins or not, or fiat. How much of that back end movement do you see changing with AI in general and then agentic payments?
I think there are two aspects to that. So I wouldn't necessarily treat AI as a technology, LLM models the same as agentic payments.
Yeah.
So I'm glad you said that. So from an, AI perspective and, leveraging large language models, I think, using the data we already have, and I think that is a strong, moat for us because we have so much traffic flowing through our pipes in so many different destinations, so many different partners. We can really leverage that data to give us insights. And we're already looking at, some of our new modeling around forecasting where the gaps are using LLMs for that. So it's helping us with some of the modeling and the forecasting. And again, as we started with stablecoins first, we're looking at internal piloting first. How can we use it internally to optimize before then maybe we can actually pass on those efficiencies to customers? So that's how we're leveraging AI, which is more around the modeling of forecasting in FX and liquidity. And then on agentic payments, and this is a question to yourselves as well, Lisa and Rami, around, do you think we'll get to a point where, as a business, you delegate an agent to manage your treasury on your behalf? And it's an open question. And that comes back to that trust and reliance factor on how far down the road would you go for those types of flows?
I can take this first. I think we're not there yet. There's always going to be some kind of fail-safe human in the middle step. Just because people, it's the reason why we don't have autonomous airplanes, etc. Like people are not there yet where they can just give the machine like the ultimate power there. But I think the thing is, before we say never, I would argue that we are in a way not using agentic payments today or an agent to kind of make decisions, but we have rules built into our systems, right? That say like, hey, the moment you reach this threshold, go ahead and do this, right? We've relied on if then statements for decades now in software. I mean, essentially the agentic payments is a if then statement on steroids, if I could kind of call it that way. But we've been fine having software make decisions for us. Now, granted, these decisions are very coded and they have clear guidelines on what can and can't happen. And now with the introduction of agentic payments, there's a little bit more freedom that the agent can use, like to kind of understand what's happening and then make maybe better decisions. But I think it's more of a mental thing and less of a technology or enablement thing. And I think and when I say mental, it's like just people getting comfortable with that. And I think once people get comfortable with smaller amounts, right? Like, hey, I'm going to use an agent that's going to do most of my shopping. It's doing a great job. It's ordering groceries on time. The groceries are actually kind of in line with what we eat. Like, it's learning as we go. Like, once we do that, and then I think that's how like this slowly gets to bigger amounts, and then pretty soon we will have at some point where people are moving hundreds of thousands of dollars or millions of dollars a day using agentic payments. But I feel like the strength of the system is only going to be as good as the human in the middle failovers. Rami, what do you think? You're
Yeah, I probably agree with you. I don't see, the treasurer of Shell anytime soon deciding to just hand it all over to an AI agent. I can see them doing experiments and ring fencing very small amounts and saying, right, okay, for this pocket of cash, these are the rules, and learn and implement. And the thing is, I guess there needs to be the availability, interoperability, the availability of other products. What's the job of a treasurer? A job of a treasurer is to safeguard the money, make sure the payments are there and used in the right, delivered to the right destination for payees, and generate a yield on excess cash. Those are the three main mandates of a treasurer. If that's the case, I can see stablecoins, tokenized money being part of that journey as that goes on chain, because more payments will be on chain. But you need to have the ability to earn yield on chain, because it's problematic to go in and out between these two different things. And those three problem statements can all be programmed. Like you said, an AI, AI or APIs or all these kind of things have existed for a long time. This just gives it a more less human-centric nature. You're able to just do it immediately. So that's the advantage. But to your analogy, Luther, we don't have autonomous planes yet, but we do have autonomous cars. I see them driving around Abu Dhabi at the moment. Although, ironically, they've got drivers in them. They're just sat there doing nothing. So we don't trust them that much. But it's happening. So we're going to reach I think I've been in a cab, but I can't remember where it was in the States, but there was no driver. In certain states, the Tesla will just turn up and you'll get in and it'll go to its destination. So bit by bit, we are getting used to or getting comfortable with the capabilities of the technology to do tasks that were previously just reserved for humans, or were felt they needed to meet a certain threshold in order to be done. It couldn't be done by a machine. Now we've reached that stage, and I think finance will also reach that stage. Yeah. I think one thing we haven't thought about is the programmability of the money. That's the issue. Like, I think Agentic is interesting, but it's the programmability. That's where I feel like there's more interesting if-then statements. You could do an AI to program the money to do stuff. That's quite cool.
Yeah, and I think that's a core characteristic of the blockchain, right? Which is, as you mentioned, smart programmable money. So we've touched upon the liquidity optimization topic quite a lot. And again, that's where we're exploring that with, is actually, can we leverage smart contracts? So, I mentioned pre-funding trap liquidity being a problem. So, you're leveraging technology like, JP Morgan's tokenized deposits with the, Connexus platform, being able to actually have logic in place, smart logic, which actually means, a customer could, commit or pledge, their pre-funding currency and amount to us, but actually not draw down on that. So it becomes this money movement where, I think everyone wants to move to a world where it's, real-time funding. So ideally, you want to move away from the whole pre-funding model. And a lot of things have to come into place for that, because you need it on the funding side of the customer and also on the receiving payout side of things. And we're exploring potential flows where that could work. But that is I think where we want to work towards, which is everyone being using smart programmable money to do that. Just one thing I'd add, Rami, around we talk about how will agentic payments really kind of take off. I think you mentioned also about the guardrails being in place. So I think as you mentioned, for small retail flows, maybe we might start dabbling in, but for it to really take off, the guardrails really need to be defined. And a lot of what the market players are doing now, which is trying to, I think, consolidate how the guardrails come in place is key. So we're seeing a lot of traction in, we call it the KYA, right? Know your agent now,
That's
so
right.
the new
Yeah.
concept.
Yeah.
That's going to help. And ultimately, I think regulatory authorities will start to explore, well, how do we put a regulatory framework in place? Just like we've done for stablecoins, for tokenized deposits, now for agentic payments. I think as we see that, we'll start monitoring that, see how it evolves. And ultimately for us, we said around Thunes being an enabler for on and off ramping. For agents to operate using stablecoins with a stablecoin wallet, they need to somehow get that in the first instance, or they need to get out of it. So again, I think that's where we leverage our same ecosystem. So I think it's a win-win for Thunes because that's where our strong moat is.
Yeah. Yeah, I think you're right. I'm glad you raised it. I think the guardrails are not just industry set. The guardrails are going to have to be set by the regulators for the larger institutions to really find comfort in what's happening. So I think that needs to give you that. There was all this stuff recently with Claude. I think, was it Fable? One of their programs got shut down for international users. I think I was using it, then I couldn't use it again. So, there are limits with AI, and there can be backfires, PR backfires, but also problems with them. So if you need to have those regulatory guardrails in place. And one thing actually I wanted to ask you, Pritpal, you're in a unique position. It's just very nice to have you on the show. In terms of one of the issues with digital money is, of course, it's super quick now, to the point that sometimes it's too quick. Because to the other side, it's all great to send immediately, but sometimes the funds are not in place to take out on the other side. So sometimes having the floats in place was useful. And as you said, you don't know exactly, or you're testing through AI, you've got a lot of access to a lot of data in terms of where you need to pre-position the money, for things to happen and for smooth operations of business. And what can happen is that you may need a float now, quick supply chain finance effectively on the receive side, because the money's moved too quickly, and normally you'd have had a day or two to get everything in place. How do you see you changing or how are you adapting your logic and your business management for this kind of inversion of the speed? It's not now slow, it's now too quick, and you've got to slow it down somewhere on the other side, and maybe your funding is at the other side rather than the send side, if you know what I mean.
So as we're trying to optimize and looking at our network partners, both existing and new partners, so we see where is demand for our network partners on a global scale for stablecoins. So, and we're seeing that wherever there's demand for, hard dollars in today's world, there's potentially a demand for also digital version of that. So one is where's the actual demand for our network partners for those corridors. Secondly, again, I come back to regulatory requirements and also capital control. So we know in some regions, you can't initiate cross-border payments unless you funded, a bank in a foreign currency. You can't actually use, a stable coin. It's a de facto ban. So that rules that out. Thirdly, also is around, if we're using liquidity partners and we're sending them stable coins, can they actually then convert to local currency and use a domestic rail then for actual local delivery? Because sometimes the domestic rail doesn't support real-time delivery. It's also, most of the majority, well, I say most, quite a lot of corridors now have domestic real-time payments, which is fantastic. But in some emerging markets, they still don't have that. So as you mentioned, great, we can get stablecoins over. Yes, maybe we can even get the FX ready for payout. But that last payout is still at the mercy of the local domestic rail. So I think what we're optimizing for is that end-to-end flow where we know that we can leverage stablecoins to get the FX liquidity optimization, convert to local currency, and pay out using domestic real-time rails. So when a customer submits a transaction, it's all abstracted away from them, and all they see is a send instruction, an API call back saying your payment's gone out the door. Otherwise, it gets trapped on the off-ramp side.
Yeah. One thing that I want to touch base as we could start to wrap up here, Pritpal, and we started the conversation with what is money. I want to kind of go a little bit deeper on that thought. Money was also always something that I would say most people trusted, right? Like, I mean, there's a lot of trust in like the physical money, And then there was, okay, how much can I trust this random number that shows up in my bank account every morning? And if it changes, I hope I explain to myself why it changed. Um, and and then over time, things started to happen where fraud came in, and then there was things like FDIC insurance here in the U.S. that started to come in. There was a recent headline that said that stablecoins are not covered by FDIC insurance here in the U.S. at least initially, right now, right? And I know FDIC insurance is more of a US concept. I don't know if that exists across the globe. In many parts of the world, you don't have this thing. And for those listening outside the US, it's an insurance up to 250,000 that the federal government, actually the Federal Reserve, comes in and provides insurance for bank accounts.
The UK has a similar one, Luther. It's the Ombudsman scheme, which I think
Okay.
just got recently increased. I think it used to be 80,000. I don't know how much it is now, but it's I think it might be 150 grand or something now.
I think it's 120,000. Yeah,
120. Yeah.
Nice. How do people, when they're viewing at this landscape of this very quickly evolving digital assets, you've got tokenized deposits, which most probably will kind of keep that insurance schemes where they're present. You've got digital assets like USDC and USDT that don't have the protection. Like, how do you see people kind of trying to wrap their head around this weird, oh, this money says it's the same thing as this money, but they operate differently?
I think the way to frame it is domestic versus international use cases. So
Okay.
domestically, there's still the question of, if you're in the US, why would you choose to hold a stablecoin rather than, a traditional fiat balance, whether it's in your Venmo account or actually with a bank? Because there's the protection issues, right? Now, if you're then sending the stablecoins or you're receiving it, in a emerging market, for example, then it's more of a store of value, which is a protection against your local currency. So actually, I think it's offsetting the risk of knowing that it's not insured because it's privately issued versus actually, if I hold my local currency, it's going to be deflated away. So actually, I'm losing value as it is. So I think it's a trade-off between risk appetite for individuals. I think it's more so for those emerging, highly volatile currency holders that see that as a kind of flight to safety. I think that's where we're seeing it.
That totally makes sense. It was wonderful having you on the show, Pritpal. Where can people find you?
Yeah, great. Yeah, so you can find me on LinkedIn personally. For Thunes, you can reach us on our website. We're quite active on LinkedIn as well.
Fantastic. If today's conversation clarified anything, it's this. The stablecoin infrastructure race is being won in production, one corridor, one compliance decision, and one agentic edge case at a time. If you're building or evaluating cross-border payment infrastructure and thinking seriously about stablecoins as a funding rail, please share this episode with your treasurer or product team. Like and subscribe wherever you listen to this podcast, and see you on the next one. Thank you. Before we wrap up, a quick disclaimer. The opinion expressed here are those of the hosts and the guests and do not represent the views of their employers or affiliated organizations. The conversation is for educational purposes only and should not be taken as legal, financial, or investment advice.